Hello, everyone. Thank you so much for joining us today for our small business webinar. My name is Teresa Rickard, and I lead our practice growth and marketing team here at Jones & Roth. We're really glad you've joined us for today's session. We're going to be diving into the topic of management reporting and key performance indicators, or KPIs. And we will have a Q&A at the end of our session. This is a really great opportunity to ask questions about your particular situation and how this topic relates to you. So at any time during the presentation, please drop your questions into the questions panel and we'll tackle those at the end. And also you can access today's slides and the handout PDFs in the handouts panel. Before we get started, I do want to just do a quick intro to our firm. Founded in 1946, Jones & Roth is one of the largest CPA and business advisory firms that's headquartered in Oregon. We have offices in Eugene, Bend, and Hillsborough. With over 110 team members, we have 50% of our partners are women, and 20% of our team is remote. Our small business team specifically is a team of experts working in the small business area and experts in accounting best practices. We work with both small and mid-sized businesses in this team, and we provide coaching, expert tax and accounting advice and guidance, and employer support. And our goal really is to help owners reach their professional and personal financial goals. So we're thrilled to have some of our clients with us today and some folks who are new to us. Welcome. Today, our speaker is Tricia Duncan. She works with our small business group and leads our firm operations, and her areas of expertise span assurance, tax, and advisory, and a variety of industry and service niches. She's a University of Oregon alumni, and she enjoys running marathons, CrossFit, hiking, travel, family, and volunteering. Tricia, welcome. Thank you so much for being here today. I'll let you take it away.
Great. Well, welcome everybody. So today we're going to cover management reporting. What is it? Why is it important to you and your organization? And within the management reporting, how do you develop key performance indicators that help you manage your business? So before we jump into the topic, just a couple poll questions for you to see where everybody's at. So I'm going to launch the poll. Hopefully that's popped up for you. I'll give everyone a couple seconds to fill that out. So do you currently have a set of key performance indicators for your business? Just give it a little longer. Got a few more votes coming in. Still coming. All right. So it looks like about a third of you said yes, 50% said no, and a few of you are like, that's why I'm here. I'm trying to figure out what a KPI is. So how about for those of you that said yes, that 3%, how often do you use your key performance indicators? So if you answered yes to that first poll, let us know how often you're using them. Are you using them regularly, sometimes, never? Give it a couple more seconds. Oh, great. You all said yes. So that's awesome that you have them and are using them. So we'll get into how do you create them and what are they for those of you that are looking for more information. So first of all, let's just start by talking about what the difference is between financial reporting and management reporting. So financial reporting are things you think of when a CPA prepares your audit or your reviewed financial statements. They tend to be requirements from external users. So your bank, your bonding agency says you've got to have a CPA come in and prepare a financial statement for your business. They are focused on your financial performance, and they're based on a structured framework of regulated reporting standards. So they have a very similar reporting standard across the board, which makes it easy for external users to read those and understand them. So very compliance-based, tends to be external users. So they can be useful internally in your business, but probably not as useful as management reporting. So management reporting, the intention is to help the inside users, your internal users in your business, to provide information and measures that help you and your team run the business, make decisions as things come up. So they identify those useful measures that give you a picture of how the business is doing, and they vary by organization, by department, by user. So as we talk through this today, we'll touch on a lot of these components. But management reporting's sole purpose is to help you in your business make decisions and run the business effectively, know where you're going, and if you're on the right track. So let's have you do a little self-evaluation here. So as you're thinking about what sort of reporting you have internally, and that could be financial, your accounting records, that could be information in your point of sale systems, in your bidding programs, all sorts of places that you have information that gives you insight into how the business is doing. So 5 things to ask yourself. Are you getting the right information at the right time? So something pops up, do you have the information you need to deal with that issue at the right time? Are you identifying leading and lagging indicators? So leading indicators are anticipating what's going to happen, where you headed, and lagging indicators are saying what happened, what went on with the history of your business. So both are important. How much time are you spending creating this management reporting? So there's a balance of how much time you spend to pull the data together versus how much it benefits you. So do you do some cost benefit analysis for that? Are those key management reports clear and transparent? Does everyone understand what they're measuring and what they mean? And then how do you align reward systems with performance to ensure you're driving the right actions for your business success? So those are some questions to ask yourself about your current systems, and then we'll start talking through a little bit more about things to be looking at. So when we're talking about management reports, there's a wide variety of what that looks like, and they're all based on what's important in your particular business with your particular team and your particular circumstances. But some common areas of management reports are reports from a departmental standpoint, or a location, or product line, customer segment, market share. It could be around sales teams or your production teams. It could be performance-based, efficiency-based, or it could be financial-based, such as a budget. So there's a variety of ways to get this information to the right people in your management. So it's keying into what information do we need and how do we organize that information to get it to the right person at the right time. So some success factors to consider. First one is it's got to be good data, right? If it's bad data, you're getting bad information. So we worked with a construction company quite a few years ago where they were trying to improve their net profit. And a piece of that, they were looking at the gross profit on their individual construction jobs. And the gross profit was trending well, but the net profit was not following. And what we found when we dug into that is that when they were out at the job site, the job managers weren't picking up all of the materials related to that job. It wasn't including all the materials that they were using to do that job. So the profit on the job standpoint looked really positive, which they felt should show to the net income down the road. But because the data was not appropriate, they were relying on key performance indicators and measurements that weren't accurate. So make sure that the quality of the data that you're using for management reporting is good. You want your management reporting to align with strategies and goals. So you don't need to have a big formal strategic plan in place, but what are you trying to accomplish over the next quarter, the next year, the next 5 years? And we want to measure things that let us know, are we heading in that direction or not? And reporting should answer those key management questions. So these are the critical things in our business and the information is telling us how we're doing. They need to be timely and relevant. So if you're giving information that is meaningless to a certain user, there's no need for them to look at that. If it's taking months to get that information, you don't have enough time to adapt. So timely, relevant information, and it needs to be customized to the user. It might be a department head or a sales manager or HR or internal accounting. And when you're customizing the data that you're giving to those users, also consider the presentation. So I'm in public accounting. A lot of us love numbers. We are happy to look at raw data and numbers, and that's great for us. But we also work with people that are not comfortable with that, and they're much better with a visual presentation, a graph or trend analysis. So consider the presentation of how is the user best receiving this information to be able to make decisions based on it. So those were general thoughts about management reporting. Let's drill into key performance indicators. So we're going to talk about how do you decide which are the right KPIs for your business, how to create that KPI that can be measured reliably and consistently, how to implement the monitoring of KPIs, right? So if we create them and never look at them, that's not useful. And then how do you use that data to help your business continue to move in the way you want or adapt to where you want to go. So first thing to think about with KPIs are the uses of measurement. So KPIs essentially are quantifiable measures of how well your business is performing or an activity is performing that's critical to the success of your business, right? So what sort of things can we measure? We can have a straight measurement of activity. So we produced 500 widgets this month, 2 employees left this year. That's a straight measure. It's information. It might not meet that KPI description totally. You could also compare results. So let's compare this year's actual results to last year's actual results. And you can compare as an indicator against a preset goal. So we set a goal of sales for this month. How did we do compared to that? So as we're developing KPIs, we're going to think through these measures to create a clear measurement system so that you have a way of figuring these things out that everybody understands. Those measurements and comparisons are what gives you the how well are we doing. So again, we could measure 500 widgets. That doesn't tell us whether or not the business is heading in the direction we want it to go. It doesn't give us the how well are we doing type of things, or what did we expect and how does that compare to the actual activity. So we need that how well numbers. So without the how well, you're essentially driving down a road without a map. You don't know, are we still going the right direction or not? So comparing those against either a trend analysis with some goals that we set or to industry benchmarks, those will all help us set the goal so that we have something we're measuring against. That helps us figure out what's going on down the road. Now, again, you don't have to be really, really robust in creating a strategic plan, but stepping back before the beginning of the year and saying, what are we hoping to accomplish? What are the key areas of our business that are really important to meet the goals that we have identified? That's what we need to measure, and we need to have some how well component too. All right. So selecting KPIs to monitor, you've got a handout in there with hundreds and hundreds of possible KPIs based in functional areas of a business. It is not reasonable to measure that many. So for a department or a user, probably 6 to 8 measures are what's reasonable, and they need to be around, again, those critical components of your business. So if you're worried about cash flow or revenue generation, it might be things like revenue per employee, gross profit per product line. For customer service, you might have satisfaction ratings that you're measuring. Team could be things around turnover rates, absentee rates, could be training budget, years of service. Process and efficiency type things could be things like inventory turnover, wastage rate, how fast we're getting inventory out to customers. So drilling into what are those critical processes and activities, and then figuring out what do we measure to make sure we're on the right track. So what's a useful KPI? It needs to reflect the goals of your business. We've talked about that a lot. What are you trying to accomplish, and how can we measure activities and functions of your business to see if we're on track? So those need to be critical to the success of your business, right? There's going to be things in that handout that sound really exciting to measure, but maybe they're not critical to the success of your business. And maybe that's not where we want to focus our management reporting and KPIs. Big one, it needs to be measurable. Without the measurement and the definition of the measurement, it's hard to make sure we're all on the same page. And they also need to point to things you might need to fix if something goes off track. So let's talk about those in a little more detail. So first characteristic, they need to reflect the business goals. So different businesses, even within the same industry, may have different goals. So I've got an example here we'll talk through within the restaurant industry. There's fast food restaurants, there's fine dining restaurants, and there's some commonalities to those, but some big differences. It could, when we go through the examples, it could be this extreme, or it could just be your business has a particular challenge they're going through that isn't typical of an industry. So you need to think through, again, your business goals. But let's talk through the two restaurant examples. So a KPI for a fast food restaurant, their goals typically are high volume of customer with a lower cost price point. So they're trying to get as many customers through the door when they're open as possible. A fine dining restaurant is not trying to do that same sort of thing. They typically are looking for repeat customers with higher check values. So customer satisfaction might be more important for them to measure versus fast food, we might be doing a customer turnover rate. So that choice of KPI really needs to reflect your organization's goals, your department's goals, the sections that we're breaking down for management reporting. So doing a SWOT analysis, looking at your strengths and weaknesses, opportunities and threats for the upcoming year can help you kind of figure out those goals, but you really have to think about it. Some industries, and the restaurant industry is one, have good data from an industry standpoint that sometimes can be starts for figuring out what might be a good KPI or a goal we should have in our business. Characteristic 2, so we want these KPIs to be derived from your critical success factors. So again, measuring things for the sake of measuring isn't probably worth your time. So we need to measure the things that are most important for your business success. So again, within that same, looking at these industries within the restaurant industry, that their critical success factors are very different from a fast food restaurant versus a fine dining restaurant. So perhaps in the fast food restaurant, they are measuring things like you'll go up to a McDonald's drive-through and there is a clock tracking how long it is taking for you to order, time of order, till time you drive away. And those are measures that they're checking in that fast food restaurant because that's what's critical to their success of that customer turnover. The fine dining restaurant, again, they're looking more at customer satisfaction, maybe return customer rates, and maybe the number of client complaints might give them an idea of are they working on the right things to meet their business needs. So really drilling into what's most important in your business to ensure you're going to meet your goals. Characteristic 3, we want them measurable. So this can be tough because often in our head we'll have an idea of, oh, I want to improve in this area. But when we write it down and try to define things, it can be difficult. So 4 things that you should have written down about your KPI is a name, right? So that we can refer to it, a definition of what it involves. So what are we actually doing here? The method you'll use to measure it. Where's the information coming from? Who's gathering it? What is it going to look like? How often are we going to receive it? And then what's the target? What are we trying to accomplish with this? Are we trying to improve something, reduce something, change something? So let's look at an example. There's 2 examples here, KPI 1 and 2. KPI 1 is kind of a off the top of my head, I'm going to fill out these 4 spots. So title, reduce defect rate. Your title is really just the name of it, so it doesn't need to include expected changes or measures. Those will be included later. So KPI 2 is the more ideal written KPI. We'll just call it defect rate. When we define it for KPI 1, we want a change in the defect rate from month to month. There's something not defined there, which is what is defect rate. So KPI 2 defines it. The total number of defect products recognized and rejected during quality assurance testing. That's much clearer. There's less opportunity for misunderstanding with that one. So we've defined how we're going to calculate the defect rate very specifically. Then measure, so total defects. Sounds simple, right? Versus KPI 2, so the plant foreman is going to pull data from daily statistics reported on defect products and then compile it monthly and report it to the manager. And then there's going to be a running graph showing month-by-month results that's shared with the team. Much more thought out, much more meaningful. And then target a decrease each month. What does that mean? So if we have a 0.1 decrease, is that success? If we have a 10% decrease, is that success? It's not clear, right? So KPI 2 talks about reducing the defect rate so that it's no more than 3% of products tested. So you can see KPI 2 is much more outlined in the details, and there's less opportunity for misunderstanding or vagueness, which the more vagueness you have in these KPIs, the less meaningful they become. So having very specific thought out process here helps you make sure that people will buy into these KPIs and you understand what they actually mean. All right, characteristic number 4. We want these KPIs to allow for correction. So if the KPIs are showing you're moving in the right direction, fantastic, you can celebrate that. If you're seeing they're moving in the wrong direction, you know you have something to address. And you want that KPI to lead you in the direction of what you need to be looking at to fix it, right? So we call that the subsystem KPIs. And essentially that's taking your KPI and breaking it down into more detail to see what we need to do on a lower level to impact that change. So if you think about it, sometimes you'll have company-wide goals, so maybe improve profitability. And those company-wide goals may have a different impact for different departments, processes, teams, right? So if we're trying to improve cash flow, for the sales department, that might mean either increasing sales or shifting the sales the products they're trying to sell to a higher margin product, right? For internal accounting or accounts receivable, improving cash flow might mean reducing the days in receivable. So our overall goal of improved net profit might be broken down into different sub goals by department or user, right? So we've got to think through that more granular approach as we spread these company-wide goals out into departments or user groups. So let's look at this one. when you're looking at a goal such as improving cash flow, you also want to consider both sides and that the strategies are aligned. So say you target, okay, the big piece that we have to improve in cash flow is the days in receivable. And you have your collections department get on that. And what do? They're hounding your customers, they're calling them all the time, they're sending threatening letters, and days in receivables improves. But your sales department finds you're losing customers because they felt harassed by your collections department. So as we create that days in receivable KPI that we're going to monitor, we need to consider what other components keep that balanced. So we measure both sides. So that improving days in receivables by upping collection calls and being stronger in the collections could have an impact somewhere else. So we also need to look at the corresponding KPI that balances those two out. And sometimes you won't figure that out right away. They won't be obvious. But thinking about that, something's trending in the right way, but something else is going wrong. Did we create a KPI and emphasize an activity that is impacting something else in our business the other way? So thinking through both sides of that and what the impact is as you focus one direction or not is important. So let's look at pinpointing actions. Same example, cash flow, but let's look at the gross sales component that we said was an important piece. So we want to improve gross sales, and we're seeing gross sales staying the same, and we don't understand why, or maybe they're even declining. And so we need to drill into why is that happening? We're trying to improve gross sales, it's not happening, why? So we break that down. Gross sales is typically a function for this organization of the number of leads generated and the number of leads converted to sales. So we've got to break it down and start measuring those components. How many leads are being generated? Is that increasing, decreasing? If it's decreasing, maybe then we're reevaluating how do we get new work? What are our sales processes? Are some sales teams doing better than other sales teams? What are the scripts and methods? So drilling into how do we get to that KPI and what are the things that we're doing on the ground running that impact that number. So if your leads converted to sales are declining, we might look at, again, the sales teams. Are we seeing some sales teams with higher conversion rates than others? Are we seeing that between product line, customer types? Why? So you're drilling into the why there. Your KPI has indicated there's an issue and that you need to highlight that area and drill down deeper. All right, so we know management reporting is really useful for your business and you need to have it. And we talked about starting to set up KPIs. You've got to manage this, right? So a few things we're going to go through in more detail. Information needs to be easy to gather. You need to gather it on a regular basis. It needs to get to the right person, should be shared among the people that need to see it, and you need to be able to coordinate corrective actions as we go. So let's touch on each of those. So if it's so hard to collect your KPI data that the benefits are less than the cost of maintaining that data, probably should question whether or not we should be gathering that data, right? So you want to collect it in the most efficient manner. And one of the tools that we've used in the last couple of years is technology. So we use Power BI, which essentially is a mechanism that allows us to take information from multiple databases, manipulate it, and present it in dashboards or reports that are user specific. So they can be graphs, or they could be charts, or they could be tables, but they do a lot of the manipulation and the gathering on its own, so it's a live data source. That has saved us a ton of time. There's setup there, there's thought process there, but once it's up and running, it makes it really, really easy. So you figure out some ways to do that. Technology should help a lot with that, whether it's importing, exporting, doing pivot tables, all sorts of things that you can use just Excel or other technologies for, but it's got to be easy. If it's hard, the person who's collecting it probably won't keep it at the top of their list to make sure that they're doing that in a timely fashion. So easy to gather, first thing to think about. Gather it and look at it on a regular basis, right? So if you create all these indicators, and accounting departments over the years are often the ones that are creating the KPI reports, and they send it out to the department heads, and they'll complain to the CPAs, no one ever looks at this information. So it's got to get looked at regularly. We've got to make sure we get it to the right people in the right format so that it's set up for their success. What does the user need to see, and how do they need to see it so that they can use that data? The frequency is really dependent on the activity behind it. So fast food restaurants are probably looking at some of their key performance indicators daily. How many customers came through yesterday? What was the drive-through average time start to finish? All of those are probably evaluating on a daily basis. And then other activities, maybe weekly, it could be monthly, quarterly, annually. Business health KPIs, so current ratio and debt to equity, and those tend to be longer time frames because you're looking at history and a period of time. If you're looking at those daily, you're not getting meaningful information. So once you start playing with these, that frequency will start becoming clearer to you. Oh, this is more useful. I wish I had it more often. We'll tell you to speed up the frequency. I don't need to see this every day. We'll tell you to slow it down. So you kind of work through the what is regular basis as you start playing with these and seeing how you use them in your business. Get it to the right person, right? So one of the reasons I have liked Power BI, I'm not plugging it per se, but it has made it really easy for those of us that often are the ones distributing this information, is setting up user-specific dashboards that they can go to when they're ready to look at it, versus creating something, either emailing it or giving paper, which takes time. So find that the right people, work with them on what they need to see, and then get it to them timely, quickly, so that they can make decisions fast, right? If they have to wait too long for ongoing decisions, that's not useful data. All right, promote those KPI data within the team. So I would say, if you're not using KPIs at all, start with your management team, your owners, and start getting comfortable with how we're creating KPIs, how we're getting them to the users. Get some of that structure set so that you can fine tune which KPIs are most important for your business. And then once you get comfortable with that, bring the team in. So if I've got a production team and we've got specific KPIs for order turnaround or error rate or anything else related to that team, it's useful for the team to understand you're measuring these things, and these are the key components for business success for that group of people. So it helps promote buy-in to the team because it's very clear how they fit into the bigger business plan or the business goals, keeps people very focused on what's most important in your business, and it encourages them to move in the right direction. You do need to provide a little training, so not everyone will understand what that KPI means, how that impacts them, what it's actually driving. But that's pretty simple to do within your department. And what we find is when you start giving them measures like that, especially if you tie rewards to them, they're going to come up with ideas for improving that KPI. So if there's a reward around hitting a target or exceeding a target based on a KPI, I bet your team members will get involved in how can we hit that? How can we get that reward? So again, it's making it very visible and measurable and something that they can control to help the business succeed. But again, I'd wait, if you haven't used KPIs at all, I'd wait till you fine tune them and you get pretty comfortable that these are the ones we're measuring. We know how to measure them, get them to the right person quickly. I'd do that first versus starting with the team and getting them a little confused if you're adapting too much. All right, and then when you start seeing that there's something that needs to be impacted because we're not heading the right direction, you've got to figure out, how do we coordinate a change and who's impacted by this change? So if we realize our inventory is getting way too big, tying up way too much cash, and we need to reduce inventory stock, we need to consider that that might impact another goal we might have on how fast we turn, get a customer order filled, right? So again, we're balancing those coordinated efforts to make sure if we make one change, we are understanding what the impacts are in other departments or areas in the business, and that we're not saving one to hurt the other, right? So we've got to consider the strategies across the organization to make sure that we are remembering the big picture as a whole. So someone's got to step back, the owner, the general manager, to make sure that the KPIs we're implementing within each department, area, team aren't conflicting with each other. All right. So 3 main ways of monitoring your business performance. First thing, talked about it a little bit, have a business plan to guide your activities. Again, does not need to be a full-fledged business plan, but some sort of idea of what you're trying to accomplish in the short or long run. That should drive all of those activities and what we're monitoring and measuring. You want to have regular analysis of your operations, and your financials are a piece of that, right? You want to benchmark. So some industries, again, we talked about the restaurant industry has a lot of data around different subsets of the restaurant industry. If you have a franchise business, your franchisor will also often have really good benchmarking data to see how you compare to competitors. Some industries do not at all, so you need to be aware of what you're comparing yourself to. But all of those monitoring performance help you with the KPIs, right? So if you start with what is the industry looking at, and then kind of drill down for you, that can help you identify those critical success factors and the KPIs that you should be tracking. One of the things to think about is failing to plan means planning to fail. So again, you don't have to have a big formal planning process, but having a plan in place helps make sure you're going the right direction. And so even simple starts to, I would like to improve our efficiency in this process this year, is a good place to start. If you're going down and getting all these KPIs, but you don't have that goal or that bigger picture of what we're trying to accomplish, you don't really know if you're heading the right direction. And again, your financials are a piece of KPIs for your business. So looking at business health components, such as the current ratio, debt to equity, some of the other components of business health ratios are useful to be looking at on a regular basis. Let's just look a little bit at benchmarking. This is just an example of industry data around customer complaints and orders. So a typical industry report will show kind of the lower quarter of responses, the higher quarter, and an average. So finding where you fit in there can help you set the targets and the benchmarks that you want to hit. Again, you need to read these really well and make sure you understand where the data is coming from. A lot of benchmark data is coming from publicly traded companies that have public financial statements that people can pull the data from. And so read the methodology from any benchmarking reports to see how it fits in with you and your business. Privately held businesses don't share that data in the same way. So sometimes comparing yourself to an industry benchmark doesn't make sense. Healthcare, dentists, there's some really good data, and they gather data within their industry groups. Manufacturing can be really tough. There's a lot of different types of manufacturing sectors, a lot of different size of organization. So some of those can be tough, and your benchmarking and your goal setting might be more around your own historical trend analysis and where you want to change things. So you just kind of need to consider the data if you're using external data to set those targets. So KPI monitoring systems, make sure they're happening, set up that system for regular reporting of results. Early on, if this is new to your organization, it might be useful to have a short meeting to go over the KPI reports together to make sure there's no questions, it's measuring the right things, we're getting the right information, it's in the right format, that you're all interpreting the results in a similar way. So doing that as a group can sometimes help fine-tune your KPI system so that you can make it most effective for your team. And then I was just going to show you in public accounting, I'm going to show you some data from public accounting. So in public accounting, some of the critical success factors for us are people. So our people are working on projects for our clients, and we record our time. So it's our time entry is our cost accounting system. And just like you would apply labor to a job, we apply our labor to our accounting tasks. And so we call those charge hours. So we have, and we are accountants, so a lot of the accountants really like the number component of it. This is an example of some of the things we track. So you've got by month, we've got actual charge hours, so actual hours worked on client projects compared to what we budgeted. So we have a budget by person, by niche, by month of what we estimate the hours will be. These tend to be leading indicators for us that the hours we work will translate somewhat into our revenue. And so we can rely on that as kind of indicating how things will be going. So we have actual budget, and then we have the prior 2 years, and then we have some comparisons between increase, decrease. So these are pure numbers. That works well in public accounting because we're looking at numbers every day, and they're used to using this sort of data to view information, but not everybody is. So as an example, this is a graphical format of the same information that might be more meaningful presentation to someone. So essentially the vertical columns are your years and the line is the 2023 budget. So you can see really quickly, okay, we were over budget in January, we were about right on it March, but we were way down from 2 years ago. So it gives you a visual representation. So for some people, they would rather see that than the raw data. So say we said, oh, we're really curious why our charge hours are down in March from 2 years ago. We hit almost 16,000 hours in 2 years ago, and we were just a little over 15 in the current year. What happened? That's where we drill down to those subset KPIs. So then we might want to say, which niche, which client group are we seeing that in? And again, we're looking at actual compared to actual and an increase and decrease. And we can also do that in a graphical format. And we might say, maybe we want to look at it a different way. Maybe we want to look at it by level. So our team member levels. All this information needs to still be interpreted, but we start drilling down and then we start figuring out why. Why did that happen? What did that mean? Why is that important to us? Does that impact where we're trying to go and how we get there? So just a few examples of looking at that in a different way and drilling down and having a presentation that is useful for the user. So in conclusion, a few things. So KPIs are those critical success factors, those critical numbers that are important to your business. That's what you want to be measuring, not just anything you picked out of the handout we gave you. What's important to your business right now? Those well-designed and monitored KPIs can help you know how your business is doing and target the areas you need to drill into and work on more. And then the goal setting and monitoring really are the key components. If you don't have that target and you're not monitoring it regularly, you're not sure you're going the direction you want to go. So in conclusion, we've covered a lot of information. We're happy to take questions. You can put them in the question tab on the little panel you have there. Happy to answer them. We'll stay on and people can chat with us afterwards also. But if anyone has any questions, they can throw them in there.
Great. I'll throw out a question. You've shared so much great information today, Tricia. For someone who's just starting out and maybe feeling a little overwhelmed, do you have any recommendations for just a couple of the most important first steps just to get started? If it feels overwhelming, where should they start?
Right, and it does feel overwhelming. And if you look at that handout and get overwhelmed, I think find one area in your business. It can be a very small area that you just want to start monitoring. Just take the first step and try your first couple KPIs and see how that works, and then build from there, right? So maybe you haven't done goal setting for the year, but you kind of know that, hey, this isn't working as well as we'd like. How could we measure that? Just start with one little step. And then I think you kind of find in your groups of your business, your departments, your different sectors, you can start building on there. Once you get one going where you start understanding it and feeling how that would be helpful for you, it's easier each time. It's easier each time to go with those 4 written components of the KPIs. The more you do it, the easier it is. So just find something that you want to measure that would be useful for your business and then adapt from there.
That's great. How about, here's a question for a company that is a little bit farther down the road. Do you have any insight into taking it to the next level with any technology resources or tools, maybe expanding out beyond just a spreadsheet, or do you have any thoughts on the technology side of tracking and reporting?
Again, I think it depends somewhat on your business. So like if you have a point of sales uh, technology, you probably have some pre-built KPIs already in there, and you can use that, right? Again, Power BI or Tableau, those tools that allow you to bring data in or set up a live link can help you create that. Prior to tools like that, creating even an Excel spreadsheet that creates the graphs for you and you're inputting the data. I think you have to find what works for you and what's the simplest and easiest way to get it to the people quickly, whatever that looks like, right? So it could be an import from your accounting system or your bidding system into an Excel document that then is creating graphs or KPIs for you. So figuring that out for you depends on your team skills and what you're trying to measure and where that data is coming from. I will say that, after you've been using these for a while, not only should you review all your KPIs regularly, but probably annually you should be evaluating whether these KPIs are still relevant for me. So if I have new goals next year, I might need to tweak the KPIs so that they're aligned again with my new set of goals. We fixed this, now we need to focus on that. We don't necessarily want to measure the same things forever.
Yeah, that's great. Well, Tricia, thank you so much for sharing your expertise with us today and taking the time. I do want to let everyone know that we do have a few more webinars coming up over the next few months on the topics of financial planning and tax, HR and employment law. And we also, in addition to those two, we're going to be doing a couple webinars on preparing for and filing Forms 1099. We have a series of training videos on our website on that. We'll also be doing a webinar with a chance for live Q&A. So keep your eyes open for that. And then we also have the team from Lane County Personal Property Tax Division is going to be our guest speaker for a webinar just focused on that form, the personal property tax form that businesses file. So keep your eyes open for that. And also just to remind everyone, please register for webinars, even if you aren't sure you can attend. We always send out a link to the recording afterwards to everyone who registers so that you can watch when it's convenient for you. All right, well, thank you. Big thanks to all of you who joined us. We really do hope that you are walking away with a better understanding how you might take one step forward with your management reporting and KPIs. Hope everyone has a great afternoon, and we'll see you at our next small business webinar. Bye, everyone.